Okay, thank you, Steve. Welcome, everyone. I'm glad everyone could be here. This is a new space for us. We've actually outgrown our space on the second floor. So kind of exciting that it's interesting enough for everybody and that you're coming to these events, and please come and please give us feedback. Tell us what you like, tell us what you don't like, tell us what you want to hear in the future, because we do respond to that. I also want to thank Tyler and Marcia, who helped put this thing together. From the slides to the food to the venue, etc. They really do. Our marketing team just does a fantastic job. So thank you to them both. Tyler and Marcia also get to hear me practice this over and over and over again. And I've given similar speeches of this topic before to different audiences. In fact, one time Tyler said to me, he said, you know what, I've heard this speech so much that I think I can do it. So I said to Tyler, okay, let's go, let's do it. So we presented him as the resident CPA. I sat in the audience, or in the back, just like Tyler does. Tyler gave the presentation, beat for beat, joke for joke, gives the tax presentation as if he's a CPA himself, without getting passing the exam. Person gets up in the audience and asks a tax question. Tyler shakes his head and says, you know, that is such an easy question that I'm going to have my marketing person answer that for you. But in all seriousness, they really do listen quite a bit to me. They probably can entertain their family and friends at the bar with tax topics. Anyhow, what we're going to talk about today is we want to talk about planning for retirement in general, because when we have meetings with you, we talk about retirement, and we talk about there are certain beliefs that we have about retirement, and not always do I believe that we explicitly talk about what those beliefs are. And those beliefs guide the advice that we give to you. And so we're going to take a little bit of time and just go through some of those key beliefs that are fundamental to how we think about retirement and how that impacts the advice that we give. We're also going to talk about taxes in retirement. What does the tax landscape look like? I would suggest that the 2017 tax changes are probably the most significant tax changes since 1986, back when I was learning to be a CPA and eventually practicing, and still in the 91, that was still brand new information, the 86 tax changes. We're going to talk about tax strategies as you plan for retirement, as well as tax strategies in retirement. So there's 6 guiding principles for a successful retirement. And I'll go through all of them right now, and then we'll go through them in detail. So number 1, create a plan for the retirement that you want, not that we want. Plan for a long life. Know what to expect with healthcare costs. Make an informed decision about Social Security. Number 5, don't spend too much or invest too conservatively. And number 6, while you're here, minimize your taxes to maximize your retirement. So let's talk about the first one. First principle, create a plan for the retirement you want. And what I say is, what we do is we look at where are you today and where do you want to go and how do you get there, and what does that retirement look for you? Do you want to travel? Do you want to spend time with family? Do you want to pick up a new hobby? What is it exactly that you want to do? And we can attach dollar numbers to those activities that you would like to do in retirement. And with that, what we do is we create a plan. And we create a financial plan based upon that information about what you want to do, what your goals are, what is the probability of reaching those financial goals, and it becomes an iterative process. We go through this every year, every other year, go through the plan, make sure that you're on track and what's going on, or if you're not on track, what would need to change in order to be on track. And so we go through this process of looking at the plan, looking at those numbers. And again, because over time, people's goals change, people's spending changes, health changes. And so we really like to do this, again, repeatedly, looking at those goals. In addition, we have to have a recognition that there's certain things that you can control and there's certain things that you can't control. So what's out of your control? Market returns, right? We have no ability to predict what the market's going to do. We have long-term numbers that we use, but we don't really know what will the market do this year, next year, et cetera. The other thing that's out of your control is tax law, right? Tax law changed in 2017. That was out of your control what that was going to do. We have to adjust, we have to react to what the tax law changes are, but that's out of your control. Where do you have some control? You have some control over longevity through diet and exercise and general health. You have some control over employment, whether you decide to work longer or work part-time. That you have a degree of control. And then you have total control over saving and spending. How much are you going to save either before retirement and how much are you going to spend during retirement, as well as what we call asset allocation. And what we mean is how much stocks and how much bonds are you going to have in your portfolio, as well as asset location. In other words, what type of accounts are those specific assets located in? And we'll talk about that in more detail during this presentation. Principle number 2, plan for a long life, potentially a longer life than you expected. So couple 65 years old today has a 75% or 74% probability of living, at least one person living to age 85. Couple 65 today has a 20% chance of at least one person living to age 95. So anyone retiring at 65 today should realistically plan for a 30+ year retirement. That's what we're looking at today. Now, that doesn't mean, obviously, some people are going to unfortunately live significantly shorter, and there are going to be some people who are going to live longer. But that's at least a good baseline for planning for retirement. So again, you need to make sure that those assets, those retirement assets, are going to be lasting potentially longer than you had originally thought. And by the way, every 10 years, life expectancy goes up an additional year. So, right, 55-year-olds looking at like age 86 is average, the life expectancy. So it keeps on going up every year. Principle number 3, know what to expect with healthcare costs. So the big thing is that healthcare costs are going up. They are going up significantly faster than inflation. And they're going to be a larger and larger part of your annual budget. In general, as people age through the retirement process, their expenses tend to go down. That's not the case with healthcare costs. This year was a good year, and that was that healthcare costs only went up 6.5% year over year. And that's considered kind of a relatively good year, considering that inflation was between 1% to 2%. What does that mean for you? That means that if you were spending at 65, $5,000 per person per year in healthcare costs, at a 6.5% growth rate, you're looking at about $18,000 per person at age 85. So healthcare costs are going to be a larger part of your budget as you get older. And so, in fact, what we do is we create 2 different goals. One goal for healthcare costs, one goal for retirement expenses, and we have different inflation expectations. And the reason we do is because of what's happening with healthcare in general. Principle number 4, make an informed decision about Social Security. So again, when we're talking about expenses in retirement and looking at retirement, the thing that we need to keep in mind is that what you are earning prior to retirement is not necessarily what you're going to be withdrawing from your portfolio. So why is that? Number 1, while you're working, you were saving for retirement. Now you're retired. You don't need to save for retirement anymore. So we can cut that money out. Number 2, you're not earning as much in retirement as you did when you were working. So the relative difference in income is going to reduce your tax burden. So you don't need additional income to cover that tax burden. Number 3 is Social Security. Social Security is going to cover a significant amount of your annual spending. So in this example that I'm using here, with a household income of roughly $150,000, you can see that the actual expenses needed for roughly, in this example, is roughly 75% is really what the household is spending. Of that amount, 25% or 1/3 of their spending is Social Security, and the remainder is coming from their investment portfolio. So roughly, again, of this household that had $150,000 of earnings from their work, the amount that they would spend is roughly $75,000 a year is roughly what they're actually spending, because again, the rest is coming from Social Security. So Social Security is really important because it's a big part of what people are spending today. That being said, there are decisions to make with Social Security, specifically when do you take Social Security? And the way that we view Social Security is really it's a form of insurance, right? Our biggest concern is when you're meeting with the advisors of Affiance is we want to make sure that you don't have too much life at the end of your money, right? That we can make sure that the portfolio is lasting as long as you do, and it's being spent, it's doing the things that you want to do. So what does that mean? That means with Social Security, you have a choice of when to take Social Security. You could take it as early as age 62, or you could take it as late as age 70. When you take Social Security depends on, when you take Social Security determines the amount of Social Security you will receive. So if you're age 66 at full retirement, if you take early, you'll receive about 75% of what you would have received at full retirement at age 66. And if you wait to age 70, you'll receive 132% of what you would have received at age 66. However, by waiting to age 70, obviously there's 4 years that you're not receiving Social Security, right? So lack of income for those 4 years that you'll eventually make up in the end. What you can see here on this chart, we're trying to show is that depending upon the life expectancy will determine the better strategy of whether you take at age 62 or age 70. There's one slight problem, and that is that we don't know how long everyone is going to live. That's the one unknown. So in general, because of the fact that we view it as social insurance, and because of the fact that we're looking at, on average, most people are going to be living to age 85 or longer, and a significant amount are going to be living to age 95. Our general rule of thumb is living to age 70. Now, if unfortunately, God forbid, you have something that you know that your life expectancy is going to be significantly shorter, of course, you should be considering to take Social Security earlier. But in general, this is the reason that that we give the advice that we do, and what is the fundamental theory behind that. That being said, the Social Security decision, there are other factors to think about when taking Social Security. So number one, are you working? What's going on with work? Because if you're working and taking Social Security before age 66, the tax hit can be quite high. Also, thinking about not only what are you doing with your Social Security, but what's happening to your spouse as well. So in other words, keep in mind, right, if you have 2 spouses, you have the household, you have two streams of Social Security. When one of the spouse dies, the surviving spouse gets to keep the larger of the 2, but that's still a drop in income. So thinking about what's going to happen to the other spouse and thinking about what their Social Security is going to be is really important, because waiting to age 70 for the higher earner benefits the surviving spouse. And so that's really important to think about. Obviously, your personal finances, can you afford to wait or not? Expected lifespan, which we spoke about, and then coordination of spousal benefits. While I gave a general rule of thumb to wait until age 70, that doesn't mean that that's really necessarily the case for couples. There's a lot of different strategies, and we have the tools to do that with you, and it's very individualized to determine what is the best coordination of 2 spouses. And so it's very possible that one spouse will take early and the other spouse will wait till 70. And you really have to, it's a lot of math involved, but we have software that runs through this and does this analysis and puts together our recommendation. So again, this is all work that we're doing behind the scenes, but really trying to explain to you where it is that we're coming from, or why is it that we're giving the advice that we're giving. So principle number 5, don't spend too much or invest too conservatively. Steve Lear likes to say to people, spend less than you make. It's one of his maxims that I've learned over time. And again, what we're talking about is really thinking about going back to the goal planning, assigning those numbers to the goal plan, and thinking about what it is that you want to do and how much does that cost. And then what we do is we look at how much are you spending, what's your portfolio in general, what's your assets, and then assigning what's the percentage that you're actually withdrawing from the portfolio. And looking at, well, what does that mean? What is that withdrawal rate? Is that a comfortable withdrawal rate or not? And that ties into asset allocation. And so in this example that I have, this is looking at withdrawal rates going anywhere from 4% of a portfolio up to 8% of a portfolio, and each year increasing with inflation. So the withdrawal is going for 4% plus inflation each year. And then looking at a variety of portfolios going from 100% stocks to 100% bonds. And then what the software did is it ran over a 25-year time horizon, what was the probability of running out of cash? And so you can see here that at an 8% withdrawal rate and 100% bonds, you have a 100% chance of running out of cash, of the portfolio not living, surviving those 25 years. Whereas, for example, if you had a 50-50 stock bond portfolio, you can see that you have a 95% probability at a 4% withdrawal rate. So it's really the combination, it's the interaction of how much are you withdrawing from your portfolio, as well as what is that stock bond mix, looking at the probability of success. So why is that? Why are stocks important? Because frankly put, you need stocks to overcome the drag of inflation and taxes. In this slide, we're looking at returns of stocks, bond, and cash over a 90-year period and looking at average returns. And you can see, for example, the average returns of stocks is 10.2%, but then you start stripping away inflation and taxes, and you're left with about 5.1%. Notice on the bond side, where the average return is 5.5%, you strip away inflation taxes, and your net return is 0.6%. So in general, in order for the portfolio to grow, to keep up with inflation, you need to have additional equity exposure. Taking another example, and again, this one looking at withdrawal rates, this is an example of someone who would have retired in December 31st, 1972. And for those who remember, there was a pretty large correction in the 70s. And what would have happened, and looking at average withdrawal rates, going anywhere from 5% to 9%. And what you can see is the portfolio withdrawing at 5% lasted significantly longer than that at 9%. So the message that we're trying to give is that withdrawal rate from a portfolio is really important, as well as knowing what that stock bond allocation is. And it's that combination that's very important and helps to determine what's the likelihood of the portfolio lasting through retirement. Okay, principle number 6, why you're all here. Minimize your taxes to maximize your retirement. So before I talk about that, I want to make sure that we're all on the same page in terms of understanding the different types of accounts that we have. And there's really 3 main types of accounts. The first account is tax-deferred accounts. And that's your IRAs, your 401ks, 403bs, retirement plans. This is money that is withheld or contributed to an IRA, but it's pre-tax dollars. It grows tax deferred, and when you withdraw it, it's taxed at ordinary income tax rates. The second one is tax-free accounts or Roth IRAs, Roth 401ks. These are dollars that you're putting in after tax, so you've already paid the taxes on it. It is growing tax-free, and when you withdraw those dollars, there is no tax paid on those dollars upon withdrawal. Now, keep in mind one other thing. Roth 401ks, you are required to take distributions at age 70.5. Roth IRAs, you are not required. So there's different rules even among the different accounts or investment type of accounts. The final one is taxable accounts. So this is, again, after-tax dollars that's put in a taxable account, and you are taxed along the way. So for interest, you're taxed at ordinary income tax rates. For dividends and gains, like realized gains, capital gains, you're taxed at preferred tax rates, at a different tax rate. Think of this as a 3-legged stool. Ideally, it's helpful to have all 3 legs and have assets in all 3 legs in order to maximize different strategies at different times. Okay, so what income is taxable during retirement? So first is pension income. If anyone, which a lot less people are receiving pensions in general, but pension income is taxed at ordinary income tax rates. Social Security is also taxable. Up to 85% of Social Security is taxable income to you. Annuities are taxable income. For annuities, it works that it's income. It's called FIFO, first in, first out. Income is taxable first, and then whatever you put in, your contribution, that is then return of capital, your return of your investment, and is not taxed. Withdrawals from IRAs and retirement plans, we talked about that. Those tax deferred accounts, that's taxable at ordinary income tax rates. And then finally, interest, dividends, capital gains from your taxable accounts, that's all taxable at, again, different rates. We gave you a sheet to help you to see what is going on in terms of 2017 to 2018, as well as changes in the tax code for 2018 and what's really important to you. And the first thing is that tax brackets have been reduced. So generally speaking, most people are going to be in a lower tax bracket in 2018 than they were in 2017. So that's the first big change. The second big change is the doubling of the standard deduction. So if you look kind of at the top, where under standard deduction for married filing jointly, a household, the standard deduction was $12,700. It's now $24,000. If you're 65 and older, it's an additional $1,300 per person. So couple that's age 70, you're looking at a standard deduction of $26,600. Personal exemptions, out the door, gone, zero. So that's gone. The other big change is the itemized deductions have changed. So the big thing here in Minnesota is that state taxes are capped at $10,000. So that's the most that's going to be deductible, which for a relatively high tax state, which Minnesota is, that's going to be significant. The other thing is itemized deduction, the miscellaneous deduction of 2%, that also is gone. I don't think that affected all that many people, but again, that's what it is. Other deductions, and none of the itemized deductions are on this slide on here, but just again, to know what's happening in terms of the itemized deductions. Medical deductions are going to be in 2018 will be 7.5%, kind of that floor. Expenses above 7.5% will be deductible. They'll be going up to 10% in 2019. I don't write these rules. I don't know why they make it so complicated, but that's what they're doing. Two things that are staying, charitable contributions as well as mortgage interest. So that's not changing. However, because of the doubling of the standard deduction, significantly more people are going to be taking a standard deduction than will be itemizing. So for a lot of people, this is going to be a lot easier to file their taxes because they're just going to take their standard deduction. But that also means that for people there's going to have to be thinking about what do we do with those previous itemized deductions, and is there anything we can do to take itemized deductions in certain years and possibly take standard deduction in other years. And I'm going to ask to hold off on questions until I get to the end, just in case, because a lot of information that we'll be covering. So what strategies can you do prior to retirement from a tax planning stand? So the first thing is to really consider saving more now. In other words, the recommendation for people in retirement plans of employee and employer contributions is roughly 12 to 15% of your salary. So consider trying to save as much as possible, as much as you can afford to save. Now, obviously, don't go crazy. Don't go from 6% to 12%. I mean, that's going to be pretty significant. You really want to try and work it over time to try and build that savings amount. But really, that's going to be one of the big changes. The other thing is the Roth IRA. So you really want to think about the Roth IRA. That is still one of the best tools that is available to savers today. So why do I like the Roth IRA so much? First of all, I just said tax brackets are going down. So we're paying less taxes than we were, again, as a country in 2018 than in 2017. That being said, we also know that the government is running a deficit and increasing their debt. it is, I'll say this is my belief, no guarantees, but it's my belief that at some point in time, that debt needs to get paid. And how is the government going to pay the debt eventually? I believe they are going to raise taxes. So getting assets into tax-free accounts is really a great thing. That means either contributing to a Roth IRA, converting from an IRA to a Roth IRA, or doing what we call a backdoor Roth, and I'm going to go through each one individually. You can contribute to a Roth IRA, and it gives, on the previous sheet that you have handed out, there are income limits on contributing to the Roth IRA. So it depends on your earned income whether you can contribute to a Roth IRA or not. The other option is that you can convert existing IRAs to a Roth IRA. When you convert that existing IRA to a Roth, that income is taxable to you at ordinary income tax. Now, has anyone been to the Dells? Okay, or you've been to a water, if you've been to water slide park, imagine what a migraine looks like. And that's what a children's water park is. With children screaming, babies crying, okay? And why do we go to these things? Because kids love it, right? They love going down the water park. As you know, when you go into those water parks, you go into these plastic tubes, right? You get into the plastic tubes and it shoots you down all the way to the bottom. Let's say halfway down the tube, you say, you know what, I changed my mind. I don't want to go down the water slide anymore. Can you go back? No, you cannot go back. That water slide goes in one direction, goes down. Well, that's what's happened to Roth IRA conversions. It used to be, prior to the tax law change, that if you didn't like your Roth IRA conversion, you could go back. You could change your mind. You could recharacterize it back. That is no longer. That is gone as part of the 2018 tax law change. It's kind of like being on that water slide. Once you're committed, you are in. There's no going back. There's no return. So you have to be really sure of what you want to do. We used to do kind of things like do multiple Roth IRAs, determine which ones would be higher or lower, and then we could go back, or we'll just do a rough estimate, and as we get closer to tax time, we'll reverse, you know, if we converted too much, all that's out the window now. Whatever you change, that is it. So you have to be really careful. Now, what's the backdoor Roth? The backdoor Roth is for those who have earnings that are too high and aren't able to contribute to a Roth IRA. There is another strategy that you can do, and that strategy is you can make a non-deductible IRA contribution, right? So it's after-tax dollars, not deductible. It goes into an IRA. You then take that IRA and you can convert it to a Roth. Because of the fact that it's non-deductible, there's no income tax based on the conversion. So you have an IRA, you convert it to a Roth, no income tax on it, and in fact, for a long time, the IRS never gave guidance. They didn't say, like, is this okay? Is this not okay? We finally now actually have guidance from the IRS that says, yes, we know about it. We're totally fine with the strategy. So that's relatively new, a good thing. Now, what if you have an existing IRA? So you have an existing IRA and you want to do this backdoor Roth IRA. Now you have a problem. So why do you have that problem? Imagine you have a cup of coffee, and that cup of coffee is your IRA. And you have cream, and that cream is your non-deductible IRA. And you put the cream into the coffee and you stir it together. Now, can you take the cream out of that coffee and put it into a separate cup? No, right? Once the cream's mixed into the coffee, it is one thing. Well, that's how the IRS looks at your IRAs. They don't care if you have a non-deductible IRA in this account and you have deductible tax-deferred dollars in that account. As far as the IRA is concerned, as far as the IRS is concerned, it's all one IRA. You can't pull the cream out of the coffee. You can't separate out non-deductible assets from an IRA to deductible assets. What the IRS will do is they'll take pro rata, and so they'll say, well, a portion of this is coffee, a portion of this is cream, a portion of your conversion is taxable IRA, and a portion of it's not, and we'll figure it out. So the tax hit gets high. So the backdoor Roth IRA is a great tool when there's no IRAs, not such a great tool if there is existing IRAs. The other thing is because of the fact that so moving on, But because of the fact that charitable contributions now for many people will not be a deductible expense because they're going to be taking standard deduction, that means we really need to think about what can we do to maximize our charitable contributions from a tax standpoint. So Steve and I were working on it with a client. They had high taxable income for next 2 years, and then their income was dropping because they were retiring, so year 1, year 2, really high taxable income, year 3, year 4, very low taxable income. So they were going to be taking the standard deduction for sure it was looking like in years 3 and 4. And so what we did is, looking at this thing, is we talked about kind of bundling charitable contributions. So in other words, taking multiple years charitable contributions, putting this into a donor advised fund, contributing to the donor advised fund, getting that itemized deduction in year 1 and possibly year 2, but then spending from your donor advised fund in your lower income years. So in other words, you're really trying to play with the tax brackets and looking at your income over multiple years, looking at your deductions over multiple years, and looking at what you can do to shift income or deductions into different years in order to maximize your taxes. And that's partly, I would say that's one of the big changes that's happened in the tax law changes. So I used to practice as a CPA. I call myself a reformed accountant. But when I practiced CPA at the time, really the focus was, we were taught defer, 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 right? Defer income as much as possible, defer your taxes as much as you can. You still have to pay it eventually, but you really want to try and defer it. And ideally, you take it as your income, you take the income when your tax bracket is dropping. Today, it's really a different story. And it's a different story because you really need to think about what your income is in different years and what's going on in those years, because certain income items are turning on and certain income items are turning off. The other thing is, if you are set in terms of your retirement plan, think about how can you help your children or grandchildren retire. And so this was actually an article I wrote for MarketWatch.com. I said, open up a Roth IRA for your teenage children or grandchildren. Think about that. If they're doing a summer job, you're putting in a couple $1,000. They're 20 years old. It's growing for 45 years or more. They don't have to take it out when they're 70 either. Think about the compound growth of what that would mean for a child or a grandchild. Okay, so how are taxes different during retirement than they are while working? Well, I like to say the tax code is the same. It doesn't say, well, we have one tax code for people working, one tax code for those retired. That's not the case. It's one tax code. What's really changing is that you're changing in that your income is significantly changed and it's dropping. But you also have other things going on, which is Social Security is being turned on, and you have required minimum distributions, at least starting at age 70.5 from your IRA. The other thing is, the big thing is what we talked about, the doubling of the standard deductions, the loss of the personal exemptions. So there's other things that are going on in 2018 that make it different from prior years. So what's one of the things to think about? Again, kind of the take home is fill your bucket. And so what do we mean by fill your bucket? Because of the fact that you have different income items that are turning on and turning off, you want to look at what tax bracket you are going to be falling into from a taxable income. And what you want to try and do is you want to try and maximize your income in the lower tax brackets. In other words, what I'm saying is that you may want to take income at different times earlier than you would normally have to, either by doing Roth IRA conversions primarily in order to shift that income to create taxable income, so taking taxable income earlier, in order that your tax bill over time will be lower. And same with, the other thing is, as you are in those lower tax brackets, it is a perfect opportunity to consider harvesting capital gains. Because if your taxable income, this is your taxable income, is $77,000 or less, your capital gains tax rate is 0. So you really want to think about, again, it's an interplay of multiple things that are going on with your income, with your assets, to see, can you harvest capital gains at a 0% tax rate? That's what you're looking to potentially do. So some additional strategies I want to talk about during retirement. So one is, we talked about consider the age for starting Social Security and look at when it's going to start, what you're going to receive, and how that's going to impact your taxes. Also think about the timing of IRA withdrawals or the Roth IRA conversions. Look at asset location. And when we talk about asset location, what we're talking about is we talked about the 3 types of accounts, right? We talked about tax-deferred, tax-free, taxable accounts. We also talked about the fact that we said over long periods of time, stocks grow faster than bonds, right? So putting those two together, in general, having stocks in tax-free, i.e. Roth accounts, and in taxable accounts is going to be better for you than having bonds, relatively speaking. And having bonds in tax-deferred accounts is going to be better than having them in taxable accounts or tax-free accounts. Why? Because those accounts are growing slower, right? The accounts with bonds in it, the tax-deferred, will grow slower, so it won't go up as much as the account with that same account held stock, again, over long periods of time, which means that at the time of withdrawal, whatever you're withdrawing is taxed at ordinary income tax rates. So the smaller amount, your income tax would be generally lower. By the way, we do this for you. This is all set up as part of our asset allocation, our software that we're doing in terms of looking at this information. When we say, well, we're looking at your assets and we're managing as one giant fund, that's the reason that we're doing this. We're doing this to really look at it from a tax standpoint. How can we look at the location of assets in order to reduce your tax burden? And also look at charitable gifting strategies. We talked about during planning for retirement and bundling charitable contributions. The other idea is the qualified charitable distribution from your IRA. This is, outside of the Roth IRA conversion, I think this is probably the second biggest idea and to really consider. And that is to make contributions from your IRA directly to a charity. So there's a couple rules. One is that it has to be a charity. It can't be a donor advised fund. It has to be a 501c3. You also have to be 70 and a half and older. So it has to be the time that you would be taking your required minimum distributions. If you're 70.4, doesn't work. And also, the charitable contribution has to go directly to the charity. Cannot go to you and then you give the money, you deposit in your bank and you give that money to the charity. So it can be done as either a check, where the check is made out from your IRA to the charity, or it can go directly, electronically basically, from your IRA to the charity. So we have a handout to walk through how this is beneficial to you. And so we have a situation of a household and looking at what the benefits of the qualified charitable distribution is. So in this example, you have a household with $200,000. They take out their required minimum distribution of $10,000. And I forgot one other thing. When you do the qualified charitable distribution, it applies against your IRA, against your required minimum distribution. So, right, so you take out that money, it goes against your required minimum distribution. And what that means is that your income will not show up on your tax return, nor will the charitable contribution either. So both kind of get wiped out. Okay, so what you can see in the example is that without qualified charitable distribution, you're taking your RMD of $10,000, and now we start deducting. And in this example, the home is paid for, so there is no interest, there is no mortgage. And again, we tried to make a simple example. So they have two things that they can itemize. They have state and property tax, again, capped at $10,000, and they have a charitable deduction at $10,000. So total deductions is 20, but we compare that to their standard deduction. They're over 65. And so their standard deduction is $26,600. So they're going to take the standard deduction. What you can see is that your taxable income without doing the qualified charitable distribution is going to be higher than if you did the qualified charitable distribution. And at the tax bracket they're in, the tax savings to them would be roughly $2,400 if they were to do the qualified charitable distribution. So notice, the exact same thing is happening, right? It's simply, I'm going to donate to the charity from my right pocket instead of my left pocket. but the method of doing so is significantly reducing your tax burden. So that's what that's how things are going to be different today. In addition, there are all kinds of other benefits to doing qualified charitable distribution because it's reducing your adjusted gross income. And so that can affect Medicare. So if anyone has had with IRMA, that can have an impact there. It can have an impact on other the other deductions or the phase outs of deductions. So there's a variety of benefits to doing the qualified charitable distribution versus simply just giving out of pocket. Now, obviously, if it's small dollar amounts, I mean, it's not going to make a big deal. But if you're making a significant charitable distribution, it really makes a lot of sense to have those assets come out of your IRA as opposed to doing it out of pocket. And one last thing, from an estate planning standpoint, those assets are great assets to donate because your heirs will pay ordinary income tax on inherited IRAs, but on assets that are in a taxable account, when you unfortunately die, they will increase in value. The taxable basis will increase in value, and so that they will not have to pay potentially capital gains tax. So whatever savings you are going to have will naturally go to your heirs the way it's set up. And again, so the bottom line is that you really need to think about tax planning today. It's really a multi-year game. It's no longer just simply year to year, turning your stuff, what's going on. That's just not the way it's working anymore. Okay, what about for those people who are retired or want to retire, and there's a gap between what their goals are versus how much they have? Are there any strategies that we have for them? And so we have a handful of different ideas. So one of them is to consider working longer, working part-time. Look at maximizing Social Security strategies. Look at delaying Social Security strategies. Review your asset allocation. How much stock, how much bond? Does it make sense to change that asset allocation to potentially get more growth, or maybe the risk capacity is such that it would be challenging to take on that more growth? And finally, spend less and save more. And I know that sounds flippant, but what I'm really meaning is look at your mortgage, look at what other debt. Are there things you can do in terms of refinancing your mortgage, either by decreasing your debt, looking at reverse mortgages, look at less expensive housing situations, review your insurance needs. Maybe there was insurance that you were paying for that you really don't need today. You're not working, you don't need disability insurance. But look at what your insurance needs are today. Does that make sense? And search for whatever other discounts are available. And then finally, look at what your discretionary expenses are. Finally, I want to touch on estate planning because that's the last big change that happened as part of 2017. And I'm going to only focus on the federal level because I gave a speech last year about the state tax law changes. So I don't want to talk about that in this specific meeting, but really want to talk about the federal. And the federal exemption, the federal estate tax exemption doubled. So with inflation now, it's $11,180,000 per person. So roughly $22 million is now exempt from federal tax. So if you have $20 million or less in assets, you should not be paying federal estate tax. That being said, it's still really important to review your beneficiaries, look at what your account types are, what type of accounts do they have, look about updating your wills, your power of attorney, your healthcare directives. Are those assets going in the direction you want to go? One other thing, the tax law for the estate tax exemption sunsets in 2025. So we all could be back to $10 million, $5.5 million per person, so $11 million. We could all be back to those numbers back in 2026. We don't know what's going to happen, but at least that's where things are today. By the way, one other interesting thing is that the estate tax allows for portability. In other words, right, if spouse one dies and the assets go to spouse two, the personal exemption goes to spouse two as well. So, right, so spouse two has $22 million with which they can use to offset for federal taxes. Now, here's kind of an interesting thing. What happens if spouse two gets remarried? Guess what? You lose the portability. It goes back to 11.1 for spouse one, and spouse two two new, or spouse three, has the other $11.2 million. You don't get, it's not portable and stackable, unfortunately. Okay, so what are the takeaways for, again, we really tried to go really wide, not super deep, because again, I would say the depth is really when you're having the personal meetings with the advisors. But we really tried to go really wide and cover a lot of topics in a relatively short period of time. So number one, think about the retirement that you want. It's not the retirement that I want or that Steve or Andy wants for you. It's really your retirement. Think about what is it you want, what is it you want to do. We can attach numbers to those things and think about, go through that iterative process of creating that financial plan. And talk about what, if things are working or not working, what would need to change? Could we increase your goals? Do we need to make other changes? Keep in mind changing costs during retirement, particularly healthcare expenses. Make sure your estate plan is in order, particularly your beneficiaries. I can say after 10 years of marriage, this is a while ago, but after 10 years of marriage, I noticed that my wife's beneficiary was still her sister. I was like, seriously? Like, eventually I hope you'll trust me. So you really want, it's really important. There have been, I forgot, it was like 5 years ago, 6 years ago, there was a Supreme Court case that individual had his ex-wife on the, as beneficiary, and he died, and his ex-wife got the money, and would you believe she kept it? She didn't. So you really want to pay attention to who the beneficiaries are. Look at the Social Security strategies. You know, again, have us go through those Social Security strategies with us that we can create what would be what we call an optimal Social Security strategy for you. And then review the tax saving strategies, particularly the benefits of the Roth IRA, the benefits of the Roth, as well as qualified charitable distributions for those who are 70 and older. With that, I'm happy to answer any questions that you may have.